Question 1. Topic: Taxation of annuities. Sarah, age 57, has a deferred annuity contract and is considering an early withdrawal of $30,000. Which of the following best describes the tax implications and penalties Sarah will face upon withdrawal if her contract is not part of an IRA? Sarah will owe taxes on the full $30,000 as ordinary income, along with an additional 10% early withdrawal penalty. B. Sarah will owe taxes only on the earnings portion of the withdrawal and will avoid the 10% penalty due to her age. C. Sarah will be taxed on the entire $30,000, but she will not incur a 10% penalty due to her age. D. Sarah will not owe taxes on the withdrawal since she is over age 55, nor will she incur a penalty. Answer A. Sarah will owe taxes on the full $30,000 as ordinary income, along with an additional 10% early withdrawal penalty. Explanation: for non-qualified annuities, withdrawals are taxed on a last and first out LIFO basis, meaning the earnings portion is withdrawn first and is fully taxable as ordinary income. Since Sarah is under 591, she will incur an additional 10% early withdrawal penalty per IRS rules. This penalty is applied unless specific exceptions apply, which do not include her age alone. Therefore, option A accurately reflects the tax treatment and penalty she will face. Options B, C, and D misinterpret the age exception and the tax treatment rules for deferred annuities. Question 2. Topic: Structure and mechanics of annuities. Which of the following best describes the distinction between a lifetime and a period certain payout options in annuities? A lifetime payout guarantees payments for the life of the annuitant only, while a period certain payout guarantees payments for the longer of the annuitant's life or a specified period. B. A lifetime payout guarantees payments for the life of the annuitant only, while a period certain payout guarantees payments to beneficiaries if the annuitant dies before the period ends. C. A lifetime payout option allows for periodic withdrawals of any amount, while a period certain payout mandates fixed withdrawals over a specified period. D. A lifetime payout option has no associated fees, whereas a period certain payout has a guaranteed minimum return that involves additional fees. Answer B. A lifetime payout guarantees payments for the life of the annuitant only, while a period certain payout guarantees payments to beneficiaries if the annuitant dies before the period ends. Explanation: in a lifetime payout option, the annuitant receives payments for as long as they live, with payments ceasing upon their death. In contrast, a period certain payout option guarantees payments for a specified duration. If the annuitant passes away before the period ends, the remaining payments go to a designated beneficiary. This structure ensures that a minimum number of payments will be made, regardless of the annuitant's lifespan. Option A incorrectly states that both payout types are tied to the annuitant's lifespan. Options C and D incorrectly describe the structure and cost elements associated with these payout types. Question 3. Topic: Riders and optional benefits in annuities. Scenario-based. Mr. Parker is considering purchasing a variable annuity and is concerned about the potential impact of market downturns on his income. His agent suggests adding a guaranteed minimum income benefit (GMIB) rider to his annuity. Which of the following best describes how this rider would function and the benefits it would provide? A. The GMIB rider guarantees a minimum withdrawal rate regardless of investment performance but incurs no additional cost. B. The GMIB rider guarantees that Mr. Parker will receive at least his initial investment back as a lump sum at any time with no impact on his monthly income. C. The GMIB rider allows Mr. Parker to receive a minimum level of income even if the investment underperforms, though he may have to annuitize his contract to access this benefit. D. The GMIB rider eliminates all investment risk for Mr. Parker by guaranteeing the value of his account balance. Answer C. The GMIB rider allows Mr. Parker to receive a minimum level of income even if the investment underperforms, though he may have to annuitize his contract to access this benefit. Explanation: a guaranteed minimum income benefit (GMIB) rider ensures that the annuitant receives a minimum level of income, typically based on a hypothetical account value or income base, regardless of market performance. However, to activate this benefit, the annuitant often must annuitize the contract. This feature helps protect against downside risk while retaining some upside potential. Option A is incorrect because GMIB riders typically have an additional cost. Option B misrepresents the function of the GMIB as it does not provide a lump sum return guarantee. Option D incorrectly claims that the GMIB eliminates investment risk, which it does not fully do, as it does not guarantee account value but only a certain income level. Question 4. Topic: Types and features of annuities. Which of the following best describes the primary difference between A fixed annuity and a variable annuity in terms of investment risk and returns. A fixed annuity offers guaranteed returns with no risk to the principal, while a variable annuity offers higher guaranteed returns with moderate risk to the principal. B. A fixed annuity provides a fixed rate of return with no market risk, while a variable annuity's return fluctuates based on the performance of chosen investments and has high risk. C. A fixed annuity provides a fixed return and involves investment in stocks, while a variable annuity offers a flexible return, with investment in bonds only. D. A fixed annuity guarantees returns tied to the performance of an index, while a variable annuity's returns are unaffected by market performance. Answer: B. A fixed annuity provides a fixed rate of return with no market risk, while a variable annuity's return fluctuates based on the performance of chosen investments and has high risk. Explanation: fixed annuities provide a guaranteed interest rate with little to no exposure to market fluctuations, making them low risk. In contrast, variable annuities invest in a selection of sub-accounts, often tied to stocks or bonds, leading to fluctuating returns and greater risk. Option A inaccurately suggests variable annuities offer guaranteed returns. Option C misrepresents the investment types for both annuities, as fixed annuities don't involve stocks. Option D incorrectly describes fixed annuities as index-tied and variable annuities as market-independent. Question 5. Topic: Regulatory environment for annuities. Under the Mississippi Department of Insurance regulations, which of the following is required to ensure consumers fully understand the details of an annuity contract? A. Agents must only provide verbal explanations of the annuity features. B. Consumers must receive a buyer's guide and disclosure statement detailing contract features, risks, and costs. C. The insurance company must issue an annual report summarizing all annuity features upon the consumer's purchase. D. Agents are required to disclose only the commission structure, not the fees associated with the annuity contract. Answer: B. Consumers must receive a buyer's guide and disclosure statement detailing contract features, risks, and costs. Explanation: the Mississippi Department of Insurance mandates that agents provide a buyer's guide and a disclosure statement for transparency on annuity features, risks, and costs. This requirement aligns with the NAIC model, helping consumers make informed decisions. Option A is incorrect, as verbal explanations alone don't meet regulatory standards. Option C is inaccurate. An annual report is not a substitute for upfront disclosure. Option D fails to capture the full disclosure requirements, which include details on fees and charges beyond commissions. Question 6. Topic: Riders and optional benefits in annuities. Scenario-based. Ms. Chen is considering an annuity with a guaranteed minimum withdrawal benefit rider, but because she wants to secure a stable income. If she adds this rider to her annuity, what is the most likely impact? A. Ms. Chen will be able to withdraw a guaranteed amount each year, regardless of market performance, without reducing her account balance. B. Ms. Chen will have a guaranteed income but must give up any market gains that her annuity earns over time. C. Ms. Chen can withdraw a specific percentage of her initial investment each year, even if her account balance falls, though market losses may affect her balance. D. Ms. Chen will have a guaranteed rate of return on her investment, which will increase annually even if she withdraws more than the annuity's growth rate. Answer: C. Ms. Chen can withdraw a specific percentage of her initial investment each year, even if her account balance falls, though market losses may affect her balance. Explanation: a guaranteed minimum withdrawal benefit rider allows the annuitant to withdraw a predetermined percentage of their investment each year, regardless of account balance fluctuations. While withdrawals do reduce the account balance, the rider ensures stable withdrawals for a set period or until the initial amount is recovered. Option A is incorrect, as withdrawals generally reduce the account balance. Option B misrepresents DEBA's purpose, as the annuitant still participates in market gains. Option D wrongly implies that the annuity guarantees an annual return rate, which is not the case. Question 7. Topic: Suitability and ethical considerations in annuities. Which of the following would most likely render an annuity purchase unsuitable for a client under the Mississippi suitability standards? A. The client is 80 years old and requires immediate access to funds without surrender charges. B. The client is 45 years old, looking for guaranteed income at retirement and has no other retirement accounts. C. The client is 65 years old and intends to use an annuity to transfer wealth to their beneficiaries. D. The client has a high risk tolerance and prefers investments with significant growth potential. Answer A. The client is 80 years old and requires immediate access to funds without surrender charges. Explanation. Suitability standards ensure that an annuity aligns with a client's financial needs, liquidity requirements, and time horizon. An 80-year-old client needing immediate fund access may face surrender charges, making an annuity unsuitable due to its typically illiquid nature in the short term. Option B represents a suitable scenario as the client seeks retirement income. Option C could be appropriate if the annuity aligns with estate planning goals. Option D suggests a mismatch with annuities, but it would not outright render an annuity unsuitable without further financial analysis. Question 8. Topic: Costs, fees, and charges associated with annuities. Which of the following best describes how surrender charges are applied to annuities? A. Surrender charges apply for the entire duration of the annuity contract. B. Surrender charges decrease over a set period and typically vanish after a certain number of years. C. Surrender charges increase annually as a penalty for early withdrawals. D. Surrender charges are only applied if the annuitant has added optional riders. Answer B. Surrender charges decrease over a set period and typically vanish after a certain number of years. Explanation. Surrender charges typically follow a declining schedule where the penalty decreases each year and may disappear entirely after a specified period, commonly 5 to 10 years. This structure discourages early withdrawals while providing eventual liquidity. Option A is incorrect as surrender charges do not apply for the entire contract duration. Option C inaccurately suggests increasing penalties, which is contrary to the standard declining schedule. Option D is incorrect because surrender charges apply based on the contract, not solely on added riders. Question 9. Topic: Fundamentals of annuities. Which of the following most accurately explains the difference between the owner and annuitant roles in an annuity contract? A. The owner is the person who receives the income payments, while the annuitant is the person responsible for making the premium payments. B. The owner is responsible for tax obligations, while the annuitant is the individual whose life expectancy affects the payment schedule. C. The annuitant holds ownership rights to make changes to the contract, while the owner is the beneficiary of the annuity's income. D. The annuitant is the one who controls the investment choices in the annuity, while the owner merely receives the income payments. Answer B. The owner is responsible for tax obligations, while the annuitant is the individual whose life expectancy affects the payment schedule. Explanation. In an annuity contract, the owner has control over contract decisions, bears tax obligations, and can name beneficiaries, while the annuitant is the person whose life expectancy the payout schedule is based upon. The owner and annuitant can be the same person but often are distinct. Option A is incorrect because the annuitant does not handle payments. Option C inaccurately assigns control to the annuitant, who does not hold contractual rights. Option D is incorrect as the owner, not the annuitant, controls investment decisions in most cases. Question 10. Topic: Immediate versus deferred annuities. Which of the following accurately describes the primary difference between an immediate annuity and a deferred annuity? A. An immediate annuity begins payments to the annuitant right away, while a deferred annuity has no initial premium requirement. B. An immediate annuity begins payments within 1 year of purchase, whereas a deferred annuity accumulates money for a future payout date. C. A deferred annuity provides payments immediately but at a variable rate, while an immediate annuity offers fixed payments over time. D. Both types require a waiting period, but only a deferred annuity accrues interest during this time. Answer B. An immediate annuity begins payments within 1 year of purchase, whereas a deferred annuity accumulates money for a future payout date. Explanation. An immediate annuity starts income distributions soon after purchase, typically within a year, while a deferred annuity is designed to grow tax-deferred until payments commence at a later date. Options A, C, and D inaccurately describe the nature and timing of payments for each type. Question 11. Topic: Indexed annuities. Which statement best describes how returns are calculated in an indexed annuity? A. Returns are based solely on the annuity contract's specified fixed interest rate. B. Returns are based on a combination of a fixed rate and a market index, such as the SP 500, but are subject to a cap and a participation rate. C. Returns are determined by the performance of individual stocks chosen by the annuitant. D. Returns are guaranteed to be equal to the market index performance each year, without any cap or limit. Answer B. Returns are based on a combination of a fixed rate and a market index, such as the SP 500, but are subject to a cap and a participation rate. Explanation. Indexed annuities offer returns tied to a market index with participation rates and caps that limit returns to a specified range. Options A, C, and D misrepresent how indexed annuity returns are structured, with D erroneously implying unlimited gains. Question 12. Topic: Annuity payout options. If a client chooses the life with period certain payout option, what does it mean for the annuity payments? A. The annuitant receives payments only for a specific number of years, regardless of their lifespan. B. The annuitant receives payments for life, and if they pass away within a specified period, a beneficiary will continue to receive payments for the remainder of that period. C. Payments continue until the annuitant's death, with no further payments to a beneficiary, regardless of when they die. D. The annuitant can receive an increased payment amount if they live past the specified period. Answer: B. The annuitant receives payments for life, and if they pass away within a specified period, a beneficiary will continue to receive payments for the remainder of that period. Explanation: the life with period certain option ensures payments for the annuitant's lifetime, with additional payments to a beneficiary if the annuitant dies within the period. Options A, C, and D inaccurately describe this payout structure. Question 13. Topic: Regulatory requirements. In Mississippi, which of the following is a key requirement for annuity suitability according to state guidelines? A. Agents must recommend an annuity only if it offers the lowest fees available. B. Agents must evaluate and document the client's age, financial status, tax status, and intended use of the annuity. C. Agents are required to disclose only the surrender charges and not other fees or risks associated with the annuity. D. Agents need to guarantee a specific investment return to ensure suitability. Answer: B. Agents must evaluate and document the client's age, financial status, tax status, and intended use of the annuity. Explanation: Mississippi's suitability guidelines require agents to assess a range of factors including the client's age, finances, tax status, and purpose for buying the annuity. Options A, C, and D don't fully represent the suitability requirements and may mislead clients. Question 14. Topic: Taxation of annuity distributions. When an individual receives payments from a non-qualified annuity, how is the payment typically taxed? A. The entire payment is considered tax-free. B. Only the earnings portion of the payment is subject to tax as ordinary income, while the principal is tax-free. C. The entire payment is taxed as capital gains. D. Only the payments taken before age 591 were taxed and others are tax-free. Answer: B. Only the earnings portion of the payment is subject to tax as ordinary income, while the principal is tax-free. Explanation: non-qualified annuity payments are taxed only on earnings as ordinary income. The principal is not taxed because it was funded with after-tax dollars. Options A, C, and D incorrectly describe the tax treatment of annuity distributions. Question 15. Topic: Annuity fees and charges. What is the primary purpose of a mortality and expense ME charge in an annuity? A. To cover the costs associated with managing investment options within the annuity. B. To compensate the insurance company for the risk of the annuitant's death and administrative expenses. C. To penalize the annuitant for early withdrawals. D. To pay for the advisor's commissions and bonuses. Answer: B. To compensate the insurance company for the risk of the annuitant's death and administrative expenses. Explanation: ME charges are intended to cover the insurer's costs related to mortality risk and administrative services. Options A, C, and D do not accurately describe the purpose of ME fees in annuities. Question 16. Topic: Qualified versus non-qualified annuities. Which of the following accurately describes a characteristic of a qualified annuity? A. Is funded with pre-tax dollars and grows tax-deferred. B. Is funded with after-tax dollars and growth is immediately taxable. C. It does not have any tax benefits and is subject to capital gains tax. D. It offers tax-free growth on all investment returns. Answer A. It is funded with pre-tax dollars and grows tax-deferred. Explanation: Qualified annuities are purchased with pre-tax funds allowing tax-deferred growth until withdrawal. Options B, C, and D inaccurately describe the tax treatment and characteristics of qualified annuities. Question 17. Topic: Role of the annuity beneficiary. If an annuitant dies before receiving the full payout, what happens to the remaining balance in an annuity with a named beneficiary? A. The balance is forfeited to the insurance company. B. The beneficiary may receive either a lump sum or continued payments based on the contract terms. C. The beneficiary is responsible for paying off the remaining premiums. D. The insurance company uses the balance to increase the annuity's overall returns. Answer: B. The beneficiary may receive either a lump sum or continued payments based on the contract terms. Explanation: most annuities allow beneficiaries to receive the remaining balance either as a lump sum or via continued payments depending on the contract's terms. Options A, C, and D inaccurately describe the beneficiary's options and responsibilities. Question 18. Topic: Longevity risk in annuities. How does a lifetime annuity mitigate longevity risk for the annuitant? A. By providing a fixed interest rate that grows with inflation each year. B. By offering income for a predetermined number of years regardless of the annuitant's lifespan. C. By guaranteeing regular income payments for as long as the annuitant lives, regardless of how long they live. D. By allowing the annuitant to withdraw funds as needed without any limitations. Answer: C. By guaranteeing regular income payments for as long as the annuitant lives, regardless of how long they live. Explanation: lifetime annuities provide payments for the annuitant's entire life, thus protecting against the risk of outliving assets. Options A, B, and D do not accurately address how lifetime annuities mitigate longevity risk. Question 19. Topic: Deferred annuity withdrawal restrictions. What happens if a withdrawal is made from a deferred annuity before the age of 591? A. The withdrawal is tax-free. B. The withdrawal incurs a 10% IRS penalty on the taxable portion along with regular income tax. C. The entire amount is taxed to lower capital gains rate. D. No penalties apply as annuities are exempt from early withdrawal penalties. Answer: B. The withdrawal incurs a 10% IRS penalty on the taxable portion along with regular income tax. Explanation: withdrawals from a deferred annuity before 591 were subject to a 10% IRS penalty on earnings along with standard income tax. Options A, C, and D incorrectly describe the tax implications of early withdrawals. Question 20. Topic: Taxation of annuities. When a policyholder begins receiving annuity payments from a non-qualified annuity, how is the taxable portion of the payment determined? A. The taxable portion is based on the total amount of the annuity premium. B. The taxable portion is determined by a last-in, first-out LIFO method, meaning the most recent contributions are taxed first. C. The taxable portion is determined by a pro rata method based on the ratio of earnings to total contributions. D. The taxable portion is calculated by applying the ordinary income tax rate to the entire amount of the payment. Answer: C. The taxable portion is determined by a pro rata method based on the ratio of earnings to total contributions. Explanation: in a non-qualified annuity, the taxable portion of each payment is based on the ratio of the earnings growth in the annuity to the total premium paid. The pro rata method allocates taxability proportionally. Options A, B, and D do not accurately describe how taxable portions are determined for non-qualified annuities. Question 21. Topic: Structure and mechanics of annuities. Annuities that pay out a fixed amount for a guaranteed period, e.g. 10 years, are known as A. Immediate annuities, B. Deferred annuities, C. Period certain annuities, D. Life annuities. Answer: C. Period certain annuities. Explanation: a period certain annuity guarantees a fixed payment for a specific time period, such as 10 or 20 years. It differs from life annuities, which continue for the annuitant's lifetime. Immediate annuities start payments right after the purchase, and deferred annuities delay payments. Question 22. Topic: Suitability and ethical considerations in annuities. A financial advisor recommends a variable annuity to a client who is retired, has low risk tolerance, and needs steady income. Which of the following best describes this situation? A. The recommendation is suitable because variable annuities offer higher returns. B. The recommendation is unsuitable because it does not align with the client's low-risk tolerance. C. The recommendation is suitable because the client is retired and may want growth. D. The recommendation is unsuitable because the client cannot withdraw funds immediately. Answer: B. The recommendation is unsuitable because it does not align with the client's low-risk tolerance. Explanation: variable annuities involve investment in sub-accounts that carry market risk, which may not be suitable for a retired person with low-risk tolerance. A fixed annuity would be more appropriate in this scenario. This reflects the need for financial advisors to ensure that annuity recommendations align with a client's financial goals, risk tolerance, and retirement stage. Question 23. Topic: Types and features of annuities. Which of the following statements about indexed annuities is true? A. They guarantee a fixed return with no exposure to market fluctuations. B. The return is based on the performance of a specific stock index, subject to caps and participation rates. C. They are risk-free and provide returns similar to a fixed annuity. D. They invest directly in equities and offer unlimited upside potential. Answer: B. The return is based on the performance of a specific stock index, subject to caps and participation rates. Explanation: Indexed annuities are linked to a stock market index, such as the S&P 500. They offer a return based on the index's performance, but are subject to caps, maximum return limits, and participation rates percentage of the index's return credited to the annuity. They do not provide risk-free returns like fixed annuities. Question 24. Topic: Regulatory environment for annuities. The Mississippi Department of Insurance enforces regulations concerning annuities to protect consumers. Which of the following is a required disclosure for an annuity purchase in Mississippi? A. A complete list of all annuity sub-accounts offered by the insurer. B. A buyer's guide that explains the types of annuities, the risks, and the costs associated with them. C. The maximum amount of commission that the agent will earn. D. A written guarantee of no loss of principal. Answer: B. A buyer's guide that explains the types of annuities, the risks, and the costs associated with them. Explanation: Mississippi law requires insurers to provide a buyer's guide that gives clear, unbiased information on the types of annuities, their associated risks, costs, and benefits. This helps consumers make informed decisions, while commissions and other details are regulated. A written guarantee of no loss of principal is not a typical part of the required disclosure. Question 25. Topic: Death benefits and payouts. If an annuity holder passes away during the accumulation phase and their beneficiary elects to receive the death benefit, how will the payment typically be taxed? A. The death benefit will be taxed as ordinary income. B. The death benefit will be taxed as a capital gain. C. The death benefit will not be taxed because it is paid to a beneficiary. D. The death benefit will be subject to 10% early withdrawal penalty. Answer: A. The death benefit will be taxed as ordinary income. Explanation: The death benefit of an annuity is typically paid to the beneficiary as a lump sum or in installments. The amount of the death benefit above the original premium paid, i.e., the earnings, will be taxed as ordinary income. There is no 10% early withdrawal penalty for beneficiaries. Question 26. Topic: Taxation of annuities. In the case of an inherited annuity, which of the following is true regarding required minimum distribution (RMDS)? A. RMDS are not required for inherited annuities, regardless of the beneficiary's age. B. The beneficiary must begin taking RMDS based on the deceased annuitant's life expectancy. C. The beneficiary must begin taking RMDS based on their own life expectancy. D. The beneficiary may delay RMDS until they reach age 72. Answer: B. The beneficiary must begin taking RMDS based on the deceased annuitant's life expectancy. Explanation: For inherited annuities, the IRS requires the beneficiary to begin taking RMDS based on the decedent's life expectancy, not their own. This is different from the RMD rules that apply to their own retirement accounts, which are based on the beneficiary's life expectancy. Question 27. Topic: Structure and mechanics of annuities. A client who has purchased a deferred annuity receives their first payment at the start of the 5th year. Which of the following best describes the payout phase of this annuity? A. Immediate annuity. B. Accumulation phase. C. Distribution phase. D. Deferred income phase. Answer: C. Distribution phase. Explanation: In a deferred annuity, the accumulation phase is followed by the distribution phase once the policyholder begins receiving payments. Since the first payment is made at the beginning of the 5th year, the annuity has entered the distribution phase. It is not an immediate annuity, as the payments are deferred. Question 20. Topic: Riders and optional benefits in annuities. Which of the following annuity riders guarantees a minimum amount that can be withdrawn each year, regardless of the annuity's performance? A. Guaranteed minimum withdrawal B. A guaranteed minimum income benefit GMIB. C. Long-term care rider. D. Guaranteed minimum accumulation benefit GMAB. Answer: A. Guaranteed minimum withdrawal benefit. Explanation: The guaranteed minimum withdrawal benefit ride ensures that the annuitant can withdraw a minimum amount each year, regardless of the annuity's performance or market conditions. This provides a degree of income security even if the market performs poorly. Question 29. Topic: Risk management and financial planning with annuities. How can an annuity be used to protect against the risk of outliving retirement savings? A. By providing a lump sum payment upon retirement. B. By offering fixed payments for a defined period regardless of lifespan. C. By providing lifetime income payments that continue for as long as the annuitant lives. D. By offering a fixed growth rate regardless of market conditions. Answer: C. By providing lifetime income payments that continue for as long as the annuitant lives. Explanation: a lifetime annuity is specifically designed to provide income for as long as the annuitant lives, addressing the risk of outliving their retirement savings. Other options may provide limited or fixed duration payments which could run out before the annuitant's death. Question 30. Topic: Sales practices and disclosure requirements. Which of the following is an ethical requirement for an agent selling annuities? A. The agent must recommend the most expensive annuity to ensure high commissions. B. The agent must provide clear and accurate information about the fees and charges associated with the annuity. C. The agent must only sell annuities to clients who are in the highest income tax brackets. D. The agent may not explain how surrender charges could affect the client's decision. Answer: B. The agent must provide clear and accurate information about the fees and charges associated with the annuity. Explanation: ethical sales practices require agents to fully disclose all relevant details of the annuity, including fees and charges, to ensure that the client understands the cost implications. Recommending high commission products or failing to explain key features like surrender charges would be unethical and likely violate regulatory standards.